You're just 5 years away from retirement. You've worked your whole life for this moment, but instead of pure excitement, you might be feeling a little uncertain, maybe even a bit scared. For many, the path forward can seem foggy. That's because the choices you make in this 5-year window are some of a lifetime. A small misstep now can have a much bigger impact than one made 20 years ago. This is your retirement red zone, and it's where the game is won or lost. But it doesn't have to be intimidating. I'm going to give you a complete year-by-year blueprint to help you navigate these final 5 years with confidence. We'll turn "I hope this works" into "I know this works," covering everything from your budget to your healthcare, so you can step into retirement feeling secure and truly prepared. Let's dive into what you need to be doing 5 years out from your target retirement date. Number 1. 5 years out, laying the foundation. 5 years out is all about getting crystal clear on the what, when, and how of your retirement. Vague ideas won't cut it anymore. You need a concrete plan. First, define your retirement goals with specifics. It's no longer about just relaxing more. What does an average Tuesday look like for you in retirement? Do you plan on traveling the world, volunteering for a cause you love, or maybe even working part-time for the routine, not the paycheck? Will you and your spouse retire together? These lifestyle choices are the foundation for every financial decision you'll make. Next, it's time to run a trial budget. This is one of the most powerful and overlooked steps you can take. For the next 3 to 6 months, try living on your projected retirement income. This isn't a guessing game. It's about gathering real-world data on your spending. Track everything. While many advisors suggest you'll need 75–80% of your pre-retirement income, this trial run gives you your actual number. You'll see which costs disappear, like commuting, and which might go up, like travel or healthcare. This exercise does two things. It stress tests your assumptions and, more importantly, reveals any income gaps while you still have plenty of time to adjust. If there's a shortfall, you have a 5-year runway to boost your savings, trim some expenses, or figure out ways to increase your income before you hang it up. This is also the time to check your savings progress. Are you on track? Do you need to accelerate your savings and take advantage of catch-up contributions? Answering this now gives you time to fix things without panicking. Finally, at the 5-year mark, it's time for a serious talk about risk. This isn't just about your risk tolerance, how you feel about market swings. It's about your risk capacity, how big of a loss your plan can sustain without forcing you to delay retirement. In this window, the goal shifts from chasing the highest returns to guaranteeing the highest probability of success. Number 2. 4 years out, maximizing your savings engine. With 4 years to go, the focus is on supercharging your savings. These are likely some of your highest earning years, which makes this a golden opportunity to max out every contribution you can. Now is the time to fully leverage catch-up contributions. If you're 50 or older, the IRS lets you put a lot more into your retirement accounts. For 2026, on top of the base 401k contribution of $24,500, you can add an extra $8,000. But it gets even better for those aged 60 to 63. A special super catch-up provision allows for an even higher amount of $11,250. For IRAs, the total you can contribute in 2026 if you're 50 or older is $8,600. Pay close attention to the rules here because they're changing. Starting in 2026, if you earned over a certain threshold in the prior year, those 401k catch-up contributions must be made to a Roth account on an after-tax basis. This is a huge strategic point for tax planning. Your savings priority list should be clear. First, always contribute enough to your 401k to get the full employer match. That's free money you should never leave on the table. After that, if your income allows, prioritize maxing out a Roth IRA, which gives you tax-free growth and withdrawals in retirement. If you have access to a health savings account, HSA, treat it like a supercharged IRA. It has a triple tax advantage. Your contributions are tax-deductible, the money grows tax-free, and withdrawals for qualified medical expenses are also tax-free. A smart strategy is to pay for current medical bills out of pocket and let your HSA grow, saving the receipts to reimburse yourself tax-free years later in retirement. Number 3. 3 years out. The tax and income strategy. At the 3-year mark, we hit one of the most critical phases, tax and income planning. The goal isn't just to save on taxes next year, it's to pay as little tax as legally possible over your entire lifetime. To do this, think in terms of 3 buckets: your taxable accounts, like a brokerage account, your tax-deferred accounts, like a traditional 401k, and your tax-free accounts, like a Roth IRA or HSA. Having money in all 3 buckets gives you incredible flexibility in retirement. This is the perfect time to consider Roth conversions. This is where you move money from a traditional pre-tax account to a Roth account. You pay income tax on the amount you convert today, but in return, that money and all its future growth is completely tax-free. A common strategy is to fill up the lower tax brackets with conversions each year. For example, if you have room in the 12% or 22% tax bracket, you might convert just enough to reach the top of that bracket. This is much smarter than being forced to take larger, mandatory withdrawals in retirement that could push you into a much higher tax bracket. You should also get strategic with your taxable brokerage account. If you hold investments for more than a year, they qualify for long-term capital gains tax rates, which are much lower than regular income rates. In fact, for 2026, married couples filing jointly with a taxable income of up to $98,900 could pay 0% in federal tax on those gains. When you factor in the 2026 standard deduction of $32,200 for a married couple, your total income could be significantly higher while still paying 0% on those capital gains. This is also the year to map out your Social Security plan. The decision of when to claim is huge. You can start at 62 for a reduced benefit, wait until your full retirement age, between 66 and 67, for your full benefit, or delay until age 70 for the maximum possible benefit. For every year you wait past your full retirement age, you earn an 8% increase in your benefit for life. For married couples, the strategies can get more complex, often with the higher earner delaying their claim to maximize both their own benefit and the survivor benefit for their spouse. You can go to the Social Security website and model different scenarios with your own earnings history. Number 4, 2 years out. Healthcare and de-risking. 2 years out, the focus shifts to protecting 2 things: your health and your wealth. First up, Medicare. This is a deadline you absolutely cannot miss. Your initial enrollment period is a 7-month window that starts 3 months before the month you turn 65, includes your birth month, and ends 3 months after. Missing this window can lead to lifelong penalties, so it's critical to get it right. At least 6 months before you retire, talk to your employer's benefits administrator to understand how your current coverage ends. You'll need to decide between original Medicare, Parts A and B, plus a Medigap and Part D drug plan, or a bundled Medicare Advantage plan, Part C. The right choice depends entirely on your health, your prescriptions, and your budget. And while you're still working, maximize your current employer-sponsored plan. Get that pending dental work done, update your glasses, and schedule any procedures you've been putting off while you likely have better coverage. Next, it's time to de-risk your portfolio. The biggest danger right before retirement is something called sequence of returns risk. A major market downturn in the first year or two of retirement can have a devastating impact because you're forced to sell assets at low prices just to live. To fight this, many people use a bucket strategy. You create different pools of money for different time horizons. Your first bucket is a cash reserve, 1 to 3 years' worth of living expenses in something safe like a high-yield savings account. This is the money you'll live on if the market drops, so you don't have to sell stocks at a loss. Bucket 2 might hold another few years of expenses in more conservative investments like bonds. And Bucket 3 holds the rest of your portfolio in growth-focused investments for the long haul. This structure gives you a crucial buffer and allows your growth investments time to recover. Number 5. 1 year out, the final checklist. You're in the home stretch. With just 1 year left, it's all about final checks, paperwork, and getting ready for the big transition. First, do one last stress test of your entire plan. Go over your budget, your income sources, and your investment allocation. Does it all still line up with your goals? Are there any final tweaks you need to make? This is your last chance to fine-tune everything before the paychecks stop. Next is the legal checklist. This is non-negotiable. You need to review and update your key estate planning documents, your will, your financial power of attorney, and your healthcare directives. Make sure your beneficiary designations on every single retirement account, life insurance policy, and other assets are current. An outdated beneficiary can override even the clearest instructions in your will, so don't skip this step. Finally, prepare for the psychological shift. For decades, you've been a saver. Now, you're about to become a spender, drawing down the portfolio you worked so hard to build. This can be a surprisingly tough mental hurdle, so reframe it. You're not spending down your assets, you're finally paying yourself a salary from the successful company you built over a lifetime of hard work. What are you most excited about for your retirement? Let me know in the comments below. Sharing your goals can be a powerful motivator for everyone else here.